Iran doesn't have to beat the U.S. military. They just have to beat the U.S. Treasury market. It's all fun and games until the cash flows hit. Holy cow, the system is collapsing if we take Hormuz closed long enough.
The global economy is an upside-down pyramid with that little tip on the bottom being raw materials. You take a quarter of that away, and a big chunk of that rest of that pyramid is heavily impaired.
You can't print oil. The happy outcome at this point is we walk away, we let them keep control of the Strait of Hormuz, gold goes to the moon, the dollar falls sharply, high inflation, probably yield curve control, capital controls in the United States.
Gold, silver, Bitcoin, just stocks just straight down. And then you add the giga stimulus, so straight up. In developing countries, it's energy, supply chain nuances, and food.
Military action is literally putting hundreds of millions of lives at risk by Christmas for some starvation. To be blunt, that's what we're looking at here.
In this episode, we sit down with macro legends Luke Gromen and Lyn Alden to discuss the latest on the Strait of Hormuz crisis, how we're dangerously close to breaking the US Treasury market, to massive money printing, and to potentially starving millions. I'm Nathan with the BTC Mentor. Let's get into it. All right, Luke, Lyn, thank you so much for joining me today. Very excited to have you guys sit down, especially right now. There seems like there's a ton of confusion and chaos in the markets. Just this morning, I was looking, we got WTI's at 112, Brent's at 109, but the futures for September's at 78 a barrel. We got Treasury yields rising. We got the Japanese 10-year at a 31-year high. Gold sold off. Dixie's rising. Bitcoin's trading sideways. And this all seems to be currently centered on basically oil supply constraints, what's going on in the Strait of Hormuz. So to kind of kick things off, Luke, you recently had a phenomenal appearance on the Patrick Bet David podcast. Highly recommend everybody check that one out. But you set kind of April 15th, I think, to about the end of the month, as kind of a deadline that we got to get oil flowing again. We got to get this thing opened up. Over the weekend, just recently, had Trump come out and very loudly set a deadline of Tuesday for a deal. So to start the conversation, Luke, I want to ask you, if we got things opened up this week, like we got it settled, done, Strait of Hormuz is opened this week, is it back to business as usual, or what's the extent of the damage that's already been done?
I don't think it would be business as usual if that happened, and I should say I think there's almost zero chance of that happening. That's sort of the preface to that. I think there's zero chance of that happening, or very close to zero. If it did, I think you're probably still okay, where there's going to be some disruptions. You're going to have some inflation, and it probably takes 3, 4, 5 months to kind of work through supply chains, but it's not a worst case scenario. Is based on how I'm looking at it, what I'm hearing from people, basically.
That makes sense. Lyn, your thoughts on that?
I would agree. Basically, when you take like how much barrels per day are lost because of this, if you take it over a full year, if those barrels were only lost for 2 months, it's actually a pretty small percentage of, say, total annual production. So the economy can absorb that. It's the duration that, of course, matters a lot too. I mean, at bare minimum, a lot of this will take weeks to come back online, even once the ships can freely pass through. And so there's a gradual ramp up. I mean, once you fix half the problem, at least you've stopped the bleeding. And you know, the long tail of getting literally back to whatever the exact prior levels, that's less important than getting, like, you know, a big chunk of it back. There's also scenarios where we just see gradually increasing traffic over months as more and more entities make deals with Iran. That's certainly another scenario, and that's a more bearish scenario, because it means that the oil market is materially disrupted for a longer period of time. But yeah, even the best case scenarios, we're not getting back to 100% anytime very soon.
Continuing from that thought, then, Lyn, I'll start with you. Luke has pegged kind of mid-April to end of April as kind of critical for getting this back up and running. And friend of the show, Simon Dixon, has it in his kind of theory of where things are playing out. He has the May 15th, 14th China summit. He expects there to be a negotiated deal kind of announced then. So if this were to continue on, let's say just kind of to mid-May, what would be the impact in your view, Lyn, on the global economy?
I mean, at that point, it gets pretty severe, and I do think it'll still be at least like significantly impacted by then. We'll see how much. I mean, yeah, if you had best case scenario and start to open it up now, then by mid-May, you're probably looking decent. The economy, especially markets, operate on rate of change. So as long as they see the light at the end of the tunnel, they can start adjusting. But I think, I mean, a good example, and it's fun. I'll be in Egypt in a month, so near the heart of the energy crisis, assuming my flights don't get canceled because of a little lack of jet fuel. And they're actually a good example of what a lot of part of the world could look like, because they already implemented curfews where cafes, many types of stores, public facing stores have to close by 9 o'clock at night. And that's, I mean, in a lot of desert countries, the time that people are active is shift later. So it's actually, I mean, from 9 to like midnight is like a ton of economic activity happens, and that's very curtailed at the moment because their natural gas bill per month tripled, and more than just tripled. It's like they literally just can't secure it all, because I mean they're bidding against the Europeans, they're bidding against Southeast Asians. They're not a very wealthy per capita country. Their currency has weakened pretty materially, something like 10% in a very rapid period of time. And that's, I mean, that's one example, right? So I think you see scenarios like that every week or every month that this goes on. You'll see more and more countries that are literally either canceling things, putting curfews, rationing fuel in some way. And that, of course, has very significant effects on just overall flow of just funds and capital and economic activity. More people are just impaired. I mean, you can imagine all those shopkeepers. I mean, they operate on pretty low margins. You know, they still have to pay their rent. What happens when they lose prime hours, or at least a big chunk of their business hours? Just kind of like COVID. I mean, it's like, you know, a small percentage of, especially a retail operation, is just catastrophe. And so I think you'll see that in more and more countries the longer this goes on. And when it happens to places like Egypt, it's mostly a local problem. When it happens to big creditor nations, it's everyone's problem. Which Luke covers a lot as well, and I cover that type of thing. So the worse it is, the more global and more it impacts financial markets rather than just daily lives of people.
Luke, if this continues on into like mid-May, is that mean that we're reaching the point that Lyn's talking about, where this is going to start to hit the creditor nation, start to impact global financial markets as well?
Oh yeah. Yeah, I would be shocked if it wasn't at that point. And that's the part that I think a lot of investors, a lot of commentators are missing. You know, and Lynn kind of alluded to this in part, is, you know, it's not just financial markets. You know, I've had a lot of people say, well, it's, you know, it's worth having, you know, a financial market hit if, you know, if we can stop Iran from getting a nuke. You know, and setting aside that they lied about knocking out the nukes 9 months ago, and these people are still believing this stuff. Like, let's set that aside. Um, but they're missing an engineering understanding of supply chains, a reality based understanding of supply chains, right? So I'll make a really simple example, which is, you know, 3 years ago I tried to buy, or 2 years ago, 3 years ago I tried to buy a metal insulated branded coffee mug for clients as a corporate gift, and I specified to the supplier here in Cleveland, who's been doing this for 35 years. Hey, I want an insulated metal coffee mug, branded with 0% Chinese content. And they searched for 6 months and they couldn't find any such thing. The best they could do was Yeti with 30% Chinese content, 70% American. Great. This is the part, the non-linearity that investors and policymakers aren't thinking of, which is to say, how many mugs do I buy? You know, people are looking at the gross number. Oh, well, we make 70%. We're 70% self-sufficient in coffee mugs. No, you're not. You are 0% self-sufficient in coffee mugs. If you know, it's the old poem, right? For want of a nail, the wheel was lost for loss of the wheel. The cart was lost for loss of the cart. You know, and the kingdom was lost for want of a nail. It's that same type of dynamic that people are looking at the gross numbers of supply chains. Even in oil, we're fine. We're a net exporter. No, we're not. No, not once you dig into the numbers. I mean, yes, at the gross level, sure we are, but that doesn't. We're still importing out 6 million barrels a day or something like that. So that's just like two examples of where you start to see nonlinear supply chain breaks, because it doesn't matter that we are self-sufficient and blah, 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 blah. Once Vietnam goes down, guess what? Parts of China are going to go down. Once parts of China and Vietnam go down, factories in America are going to shut down. Once factories in America shut down, in Europe, once factories in America and Europe shut down, particularly here in America, How many companies have borrowed money to buy back stock? Right? A whole bunch of them. What happens when their factories start going down around the world? Stop generating cash. They still got to pay the interest on the debt. Their earnings they don't decline linearly. They collapse. And so that's where there's this sort of linear view to everything that is just wrong. And look, the Trump administration and Bessent, and in particular, are doing everything they can to feed this lie because this is their weak point. Right? This is why Bessent is unsanctioning Russian oil and unsanctioning Iranian oil in a war with Iran.
Yes.
They are doing everything they can to maintain this lie. And I understand why. I would be doing the same thing if I were in their shoes, but it's a lie. We are. I don't know if it's 2 weeks, if it's 3 weeks, if it's but I think mid-May it's comfortable. You're going to start getting these non-linear breaks. And once this is almost like any crisis, it's all fun and games until the cash flows hit, right? Until the real physical interaction they can't pretend that when GM comes out and says we're shutting down all our plants because we can't get this little component out of Vietnam. That, the market's not going to be up that day, I don't think. And look, if it is, then, I'm going to be wrong about a lot. and I'm going to start buying everything because it's telling you we're heading towards hyperinflation, right? That's what it's telling you. Like, oh my God, the bond market's running into anything. It's a hard asset. But, we'll see.
Interesting. Lyn, I'd love to get your thoughts on that.
Yeah, there's, similar anecdotal examples, like during COVID, speaking of like cars and like a minor missing component. Part of why we had so much like temporary inflation in used cars, we had obviously major supply chain disruptions from lockdowns and things like that. And so you can have like a $50,000 vehicle that is 99% complete, but it's missing one little chip for the airbags or something, and they can't sell it because some like tertiary supplier in Taiwan was out of a certain thing that then fed into another company that actually makes the chip, and then the shipping company got delayed. Whatever chain along that path makes it that whatever reason they can't put this chip in this like nearly completed car, and so it's just sitting there. And you get a million things like that. And another example is, I'm a private investor in a consumer products company. They have American and Chinese components. They'd like to be American wherever possible, especially when tariffs were hitting. When I was having discussions with them, I'm like, okay, so how are you being hit? What do you, what are your paths of resolution here? Especially when we were talking about 100% tariffs and things like that, when it was kind of like peak negotiations. And they were looking into reshoring that as much as possible, even though they already kind of had. But they were like, okay, now we have to double down on that. And they're like, so some of the options are, in months we might be able to reshore some of it at a higher cost, but also we have to re-engineer it to be lower complexity, because people often think that like you can take the same thing, build it in America, or people, corporations are greedy and so they put it in China and make it there. But it's actually they have a network effect of manufacturing. They've got the human capital, all the interrelations between all the different manufacturers, kind of like how in Silicon Valley you got the network effect around startups and all the infrastructure, like all lawyers that know how to handle that, and financiers that know how to handle that, and all the connections. New York has the securities markets network effect. China's got this like very strong manufacturing hub that's extremely hard to over the long arc of time. You could shift it, but it's a network effect. Like any network effect, super hard to chip into. And so they're like, we literally cannot find a U.S. manufacturer that can make the part that China makes for any reasonable price. We would have to literally simplify the design, make a slightly worse product that is also a little bit more expensive, just to reshore it. And that, by the way, that'll take months of retooling and all this. And that, again, there's like a million examples like that. And so and then bringing this back to the Strait, the global economy is an upside down pyramid, with that little tip on the bottom being raw materials, energy, but also, energy is an input into fertilizer production. All these like sulfur, urea, all these other just components along that process. They're all feedstocks. They're chemicals, helium for electronics, helium for medical devices. All those raw inputs. When you add up all mining companies and all kind of processing companies, refineries together, it's a small percentage of global GDP. But you take a quarter of that away, and a big chunk of that rest of that pyramid is heavily impaired. So it's a disproportionate percentage. It's not like a little layer, a little 5% layer of GDP on top of all this that we could live without. You can live without luxury goods, or if we have a disruption in just something optional, it's like 5% of global GDP. It's like, well, we have to live without that for a period of time. But if the 5% is that bottom of the pyramid, the inverse pyramid, it's a much bigger thing than 5%.
That's insane. I kind of want to tease that out for just a second too, because I'm curious, because we've seen like shortages in Vietnam and Bangladesh. We've got the flights being canceled as well there too, the shortages of kerosene. Do we have to at some point in time start to be concerned about fertilizer and actually food supply going offline or having food shortages in areas of the world? Luke, I'll get to start with you.
Yeah. Yeah. I mean,
yes, we do. Okay.
yeah. I mean, in America, probably not. Latin America, probably not. But yeah, I mean, that's sort of, I'm kind of surprised. And again, I think there's an intentional framing of all this, right? Is, we're we're taking a we're taking a military action because the Iranian government killed 45,000 of its people, and the military action is literally putting hundreds of millions of lives at risk by Christmas for some starvation. That's just, to be blunt, that's what we're looking at here. So, is it worth it? I don't know. If it was if it was my kid that was going to starve to death by Christmas, if this thing isn't opened in enough time, and maybe that isn't May 15th, but maybe that's June 15th or July 15th. If it's not open by then, you're going to have real shortages of food across parts of the global south. And who am I going to blame for that? I'm not going to blame Iran. I'm going to blame America. I'm going to blame Israel. And so again, I don't understand the strategy here, but yeah, absolutely. We're going to see potentially, the longer this goes on, catastrophic food shortfalls across parts of what's called the global south.
Yeah, generally speaking, at the moment, we've already got increased prices of many types of fertilizer. It's not yet translated into much higher crop prices, which means at the moment it's actually really impacting farmers because all of their inputs are more expensive, but their outputs are not yet. But of course, that's not a sustainable situation. So the longer that persists, the faster their exports have to go up. When Russia invaded Ukraine in 2022, we had a faster food price response because partially that disrupted actual, like, say, rice production in Ukraine and things like that, which again it impacted Egypt because they're a buyer of that type of thing, and of course at many other countries. My understanding at the current time is like potash seems fine enough, but like other fertilizers where the issue is, it's not my area of expertise, but I try to monitor those that monitor that situation. But yeah, the longer this goes on, the more disruptions you get. The wealthier a country is, the much less likely they are to have outright food shortages because they can outbid others. So in a developed country, your main concerns are energy and supply chain nuances. In developing countries, it's energy, supply chain nuances, and food. Now, of course, in a developed country, food inflation is still an issue, especially in the political, highly polarized political environment we find ourselves in the U.S. and Europe today. So people are, rising grocery bills do impact the economy, but I wouldn't bet significantly you'd have like acute food shortages in developed countries, but you would have it in many poorer countries of the world, unfortunately, if this goes on long enough.
And kind of continuing with that thought of inflation, when you say inflation, are you specifically referring to like just prices go up in terms of like goods and services, or are you thinking there's actually going to be more money creation throughout this process as well too?
Well, at the moment, it's just the things that are in short supply go up in price due to supply and demand. So it's the inflation of prices in that sense. Now, if that is not met by stimulus for a period of time, it tends to then reduce demand for other things because there's still the same amount of, say, dollars or other currency floating around. They're now, consumers are paying more for groceries, more for gas. So they're cutting discretionary spending where they can. So you get actually, in some ways, demand destruction and disinflation in those other categories. Now, because we live in such a leveraged, financialized world, as that negative flywheel starts to go into effect, eventually you get breakages. You get snares that turn us from a gradual print into a big print, and then you get you lock in more wider inflation because then you're doing stimulus of some sort. So basically the main difference between temporary price increases or permanent price increases ultimately comes down to that money supply growing, but temporary price increases are more due to that kind of temporary supply demand mismatch.
Luke, is there anything there you disagree with, or what's your outlook kind of on inflation, both from the price perspective as well as the money creation perspective? And it kind of sounds like we're almost setting up for the same sort of thing that happened over COVID.
No, I think what Lynn said is right, which is, and that's, I think it's really important that it's that second derivative that so many people are not watching, which is all of this is happening at a time where through the first 5 months of fiscal 2026 for the U.S. government, they were already at over 100% of receipts just on interest expense and entitlements. So we literally need to print money basically to cover interest and entitlements through the first 5 months of the year. Now there's some seasonality to that, of course, with April 15th taxes. So we're going to get that bump back below 100% here. We better. But I think we will. But the point here is that we're in a position, whether it's 95% or 100%, 105%, doesn't really matter. You have a recession, a deflation, a recession in receipts, which you will if this goes on long enough. For exactly what Lynn said, right? You're going to see, you're going to see funds, the inflation of energy and food is going to cause deflation in other things, and then you're going to get a decline in receipts. You get a decline in receipts, and now you're into the sort of debt spiral dynamic that we saw during COVID, where it gets 105, 110, 115% of receipts, and you have a decision in the United States of America and everywhere else, which is, now U.S. is one of the biggest debtors, so it's going to start, probably here or Japan, but what do you want to do? Do you want to default on entitlements? Do you want to default on treasuries? Or do you want to print the money to pay the interest and to pay the entitlements? And that's what we're looking at. And that's where you end up with this big print. And it's, I think it's a critical differentiation now versus COVID. Is in COVID, it was a demand side decline. This is a supply side decline, right? So we printed, remember, we did the big print or whatever it was with the stimmies in COVID. Certainly, at least initially, oil was negative 20, negative 30 a barrel. We're going to be talking about doing this at 120. And they're going to have to, because the other choice is shrink the military massively. Well, he just told us that. He's going up to 110, 100, 1.5 trillion. So that's out. He's not going to shrink the military. There's nothing else he can cut that matters. Military, interest, entitlements. That's it. Everything else is a rounding error. And so he's increasing military spending by 40%. Okay, that's out. Well, then if you're going to shrink receipts as a result of the increase, which you're certain to do, given enough of the situation, long enough of this time of the situation, they're either going to print the money to pay interest on the debt and entitlements, or they're going to default on it. That's it. And we know what they're going to do. So then that gets into a very, very, it's hard to overstate how inflationary that is, because again, it's not a demand side issue. It's a supply side issue. You can't print oil. I mean, you sort of kind of can, actually. I mean, if you print it up to 200 a barrel or whatever, you're going to be, drilling for it in, George Washington's nose in Mount Rushmore, and we'll have plenty more come online. So you sort of can print it, but that has a very pronounced set of impacts on financial markets, politics, geopolitics, etc.
When you say print the money, do you mean basically in order, because they can only deal with maybe with interest, is basically have the Fed monetize the debt and just force short-term interest rates down in order to deal with that expense?
I think they've already started it on some level, right? Like if you look last week, 2 weeks ago, 10-year Treasury hit 4.4% 3 different times that week. It was almost perfectly timed for Easter, right? It was denied 3 times, like like the biblical story. 4.4%. Trump comes out and goes, "Oh, it's all over," right? He tacos once. Then 10-year goes down, comes back to 4.4. Then it was BB's turn. Hey, we're almost done. It went back down. By Thursday, he did it again, and it didn't react. So then last week we get what? We get the single biggest Treasury buyback from Besant on record, $15 billion of a Treasury buyback, which, the purists are like, that's not printing it. Yes, all right, it's managing the thing. But the Fed is also doing reserve management purchases at the front end. So Besant is issuing bills to buy back paper that was both from bills to it was, I think it was, everything was going to be expiring within 3 years of what they did on that at the end of last week, that $15 billion Treasury buyback. So they're presumably issuing bills to buy back bills and other things that are even probably off the run stuff. So who knows what some of that was? Anyway, it's notes and bonds. At the same time that the Fed's buying bills. So it's like, well, it's not, it's like the gift, right? It's not, they're not printing money, you know. And to me, again, they separate the cause and the effect very well. Nobody talks about it, but do I think it had absolutely something to do with the fact that they're trying to keep the 10-year below 4.4? Yeah, you bet you I do. Yeah. So, that's sort of soft core. It's not printing, but it's managing liquidity, shall we say. This would have to be full on, and again, they will never call it monetization because that's it's like a religion. But it's monetization of the debt. That's absolutely what they'll be doing. 150%, that's what they'll be doing.
When I first got into Bitcoin, I was overwhelmed. The jargon, the security risks, the fear that one mistake could cost everything. I remember staring at my screen and wondering, are my keys safe? Did I do this right? That experience is why I started BTC Sessions. For over a decade, this channel has helped millions of people like you learn how to use and secure Bitcoin. But I realized something. For many people, videos aren't enough. Everyone learns differently. Some need to ask questions in real time as an expert walks through their setup, their goals, and their threat model. And certain things like advanced cold storage, inheritance planning, privacy, and node or mining setups often can't be fully solved by watching another tutorial. So I built BTC Mentor. I recruited the best Bitcoin educators on the planet to work with you one-on-one. Real experts, real answers, personalized hands-on guidance tailored to your exact situation. Whether you're brand new or building a complex setup, we meet you where you're at and walk with you step by step. By the end, you don't just hope your Bitcoin is safe, you know it is. If you're ready for that level of confidence, then head to btcmentor.io and book a call with us today.
Lyn?
Well, these things tend to happen in phases. This particular cycle, the phase started before this. It started in late 2025, which is the funding mechanisms for entities that buy the treasuries. Those start breaking first. So in 2019, this happened with the repo spike, where just suddenly overnight, just all the the interbank lending rate just soared. This is this is what hedge funds and others will borrow to then buy treasuries. So obviously, if that spikes, you can't keep borrowing that to buy treasuries. So that's going to, if unaddressed, will impact the treasury market. So back then, the Fed put that fire out, started to go back to, first they did repo, and then they actually started just buying treasury. So they are increasing the monetary base directly. They're monetizing a portion of the debt. And we got a similar, but like a slightly more muted version this time, because we were kind of ready for it. They had the standing facilities in place. So we start to see over the course of a handful of months, elevations in that kind of securitized overnight lending market and short-term lending market. The Fed's standing facilities in place. So they're kind of providing liquidity on days where it gets a little messy. And then the longer that goes on, it kind of grows and grows, gets more persistent. So then they announce, we're going to start going to gradual balance sheet increases, roughly in line with nominal GDP. So increasing the monetary base. And that kind of put out the near-term fire. So you see less usage of the Fed's repo facility. You see lower yields on that securitized financing spreads versus, say, interest on bank reserves. You kind of at least mostly put out that fire. And if they didn't, that would translate into treasuries. And so far in this crisis, I think because they're already providing some liquidity, so far we're not really seeing usage of the Fed's repo facility. We're not really seeing credit swap lines being used, but those are, I would monitor those to see signs that's heating up. So far it's not, but if this goes on long enough, they certainly could. And then to Luke's point, the other mechanism is treasury buybacks. Now, duration neutral treasury buybacks are not, they're more a very minor liquidity boost. You're basically, if say hypothetically you're issuing 5-year notes, on the run 5-year notes, and you're buying back off the run 5-year notes. It's not great optics, but it's a quantity neutral liquidity boost to the treasury market. But yeah, if you're buying 5 and 10-year notes and you're issuing T-bills to do it, you're reducing total duration in the market. You're basically doing the emerging market playbook where nobody wants to buy your long-term debt, so you have to issue more of it on the short term. That has other effects. Like, that's part of the reason why the Treasury General Account's so big, is because they've got to roll over these T-bills so frequently, and so that has effects. And so if you reduce, and it's funny because of course Besant was critical of Yellen for having so much kind of shorter term treasury exposure, and kind of vowed to fix that. But it's like you say something and then you do another thing. You also talked about the 333 deal, which is not going to happen. And so yeah, we are kind of entering various phases of monetization, starting with the gradual print that kind of began in late last year. Nothing particularly new at the moment, or rather the size of the treasury buyback was interesting for sure. The longer this goes on, I would be watching some of these standing facilities, or the move index and other signs of stress, because if you do get treasury yields breakout, if you do get a liquid markets, the Fed will step in as needed. They'll increase purchases. They'll expand the size of their standing facilities, whatever it takes to not have a failed treasury auction, to not have acutely liquid treasury markets or interbank lending markets.
Two things I just want to quickly touch on there, Lyn. One, does that explain why, the move index, they've already had it set up, already kind of been active. That's why move has been pretty much not that, it hasn't spiked. It's been move index has been relatively down. Does that also explain why, like I think about a month ago, the front end of the curve was still inverted, but it almost looks like we have a proper natural yield curve at this point in time. And then just tagging on to that, speaking of the Fed, Kevin Warsh coming in, do you think he'd actually do what is necessary? He's historically been kind of hawkish. I'm curious your view on him stepping in May.
Yeah, so the move index briefly spiked. It has cooled off. I do think that the fact that they are doing net balance sheet increases, that the fact that they do have standing facilities, and that now they're doing unusually large treasury buybacks. These are all mitigants. None of them are particularly noteworthy in and of themselves, but they are there. And we haven't gotten to the point where creditor nations are like fire selling treasuries to buy energy yet. We're not at that phase of this, which we could find if the strait's closed for months. You could see Japan selling treasuries to make sure they bid for $200 oil equivalent, and whatever the equivalent for LNG is. So you certainly could get to these more extreme scenarios. Right now, we're not. I do think, of course, that any Fed chair would, including this one coming in most likely, would do what's necessary with the balance sheet. The steps that they talk about are, in theory, if they were to increase the duration of the treasury market, they could reduce the TGA, which could then reduce the treasury balance sheet slightly. I mean, if anything, we're moving in the opposite direction from that vision. You can slightly reduce bank regulations to let them hold more treasuries, basically let them lever up on duration a little bit more and not really be punished for it. That's another option. It's liquidity neutral. You can take a little bit off the Fed and put a little bit more in the commercial banks. Those are all minor around the market solutions. There's no Fed chair that's going to say, "Oh, the treasury market is illiquid. Tough luck." So kind of like how Scott Bessent talked about, we're going to have more reasonable treasury practices. We're going to increase duration again, and then comes into office and is not doing that. You would see the same thing with any Fed chair. Any kind of prior statements that they had go out the window when the treasury market's not liquid.
Luke, your thoughts on Kevin Warsh coming in? And also, I'm curious if you have any insight into the Japanese bond market and the impacts that might have, if any.
Yeah, I think I agree with Lyn that Warsh is going to do what he has to do, particularly now that we're in wartime. If anything, I think the Fed will become more of a financing arm, more direct financing arm, if they have to. Japanese bond market, I still think is super important, and it's not. If I came into the year concerned about it, all of this just makes me more concerned about it. I mean, one of the charts I've been following has been, if you look 10-year JGB yields 10-year 10-year JGB yield minus 10-year Treasury yield versus dollar yen, right? And so in theory, a rising relative yield on 10-year Treasury on 10-year JGBs relative to Treasury should be driving capital flows and a stronger yen. And it's not. It's driving a weaker yen against the dollar, and that's emerging market behavior, classic emerging market behavior, which is just the market saying you can't afford your interest rate now without printing a lot more money soon. And it's continuing to widen. And so to me, it's one of these things where I go, I don't know when it's going to be a problem, but it's probably not going to be it's probably not going to take a long time. And I have a pretty good idea how they're going to deal with it. And, everything that's happening with energy, a chart I've highlighted on X really since this war began. And, at the beginning, people were laughing at me and they're not laughing anymore is, dollar yen times oil and dollar yuan times oil for both versus the 10-year Treasury. And I've had discussions with people the very first weekend. 10-year Treasury yield was at 3.94% that first weekend. And I said, oh, well, that'll do it for that. It's going higher. People are like, you're crazy. There's gonna be a bid for safety. It might have traded at 393, maybe 392 even. But since then it's, right to 4.4, and they've been fighting 4.4 ever since. And you can mess with the scales a bit, but the bottom line is if this continues for long enough, what dollar yen times oil and what dollar yuan times oil relative to that 10-year yield are telling you that the pressure on 10-year yield is going to go higher. Almost, and there are a lot of things they are doing to mitigate that, as Lyn noted. There's other things they can do to mitigate it, but the release valve is all the same thing, which it's the currency. It's the yen and the dollar. And that's where they are. So nothing's really changed on that front. I think ultimately, the longer this goes on, it's still the Japanese bond market and the US Treasury market, the two biggest debtor nations of the world, are going to be the first two cracks, in bond markets whenever, in the developed world, at least, whenever this really starts to, become an issue, which I think, again, next month or so.
For someone in the US or Canada, North America that's listening to this, can you even just quickly explain why these currency flows, like why the flows between the Japanese bond market and the US Treasury market impact them, like why this matters at all, why they should be paying attention to that?
Luke, do you want to take that?
Yeah, I'll take it. It's at the end of the day, for them, it's a piggy bank issue, right? There's something called the net international investment position, which is basically how much foreigners own of our assets versus what we own, minus what we own of theirs. And the way the system's worked, particularly since the great financial crisis, is we run big deficits and they recycle those deficits into our asset markets. And so when you look at who we've been running deficits against, primarily, it's Asia, it's Japan and China in particular. And so they own a lot of our assets. And oil's only priced in dollars, primarily still, certainly for Japan. And so when oil or the dollar get too strong, and the worst case is when they both strengthen, they have to buy oil. And so what do they sell? They sell dollar assets. And what do they sell first? They sell what they can, not what they want to, which are treasuries.
Lyn, your thoughts?
Yeah, exactly. So Japan, it's funny because I've been bullish on Japanese equities for a long time, especially Japanese equities that are they're in debt in yen and they own scarcer assets, so their debts are being devalued, and they start at pretty low valuation, so that's kind of been playing out. I never really bet against the Japanese in the strategic sense. They generally make the right decision when they have to. And they have a lot of levers to pull. So when people are talking about like massive Japanese blowups, and not putting Luke in that camp, but like when I see people on Twitter talking about massive Japanese blowups, I tend to think of it more as a series of steps that they take, which they do experience pain when those things happen. But then also because they are a very resourceful and fairly wealthy nation, those issues get pushed elsewhere because, as Luke mentioned, they have a big piggy bank. So like let's say if you go back to the emerging market situation, because their currency and bonds are indeed trading like an emerging market, which happens to a developed country once it enters fiscal dominance. And so there's two main types of emerging markets. There's ones that have like very little foreign exchange reserves. So when their currency weakens, that's when you get those crazy spirals that you see. And then there are emerging markets that have a ton of reserves. So they have a piggy bank. They've had current account surpluses in the past. that they've saved up. They might even still have them in that moment, and then they can sell some of their assets, buy back some of their own currency, even as they're increasing their own currency to say buy some of their own bonds. So they have levers they can pull to say, okay, what do we want to happen too fast? We don't want our bond yields to go up too fast. We don't want our currency to devalue too fast. We don't want to sell reserves more than we have to. So whichever one is kind of like on fire at the moment, you can like take one of the other variables and put out that fire. So, for example, when the yen was like going vertically down versus the dollar in recent times, not super recently, but that was happening before. They can come in with like a shock intervention and basically put the fear of God back in the people shorting it. And you kind of blow out some of the leverage, you slow down that process, make them kind of restart their positions, and you buy back some of your yen. So if we start to see nonlinear action in Japanese government bond yields, right? So over the past like 4 years, the Bank of Japan's been flat to down on their balance sheet. We would expect to see a resumption in balance sheet growth at some point, kind of like how we've already seen with the Fed. You see a resumption in balance sheet growth. I mean, it's already kind of flattened out. It's not really going down the way it was. So you start to see a more incline upward. That, all else being equal, is not good for the yen, especially if they, traders looking at this and saying, well, they're an energy importing nation and there's an energy crisis. Now they can outbid the Egypts of the world, but it's still not great if you're Japanese and you're paying much higher dollar denominated and much higher just raw energy prices and natural inputs. So then they can increase their monetary base, buy back some of their own bonds, do kind of soft yield curve control. If the yen gets super weak, then they can sell some of their reserves, which are a large part of that is treasuries, but there's also other types of assets around the world, which then it comes and hits US Treasury markets. And then we get weird action, and the Fed has to suddenly say, okay, we were buying this many treasuries a month. We actually have to buy this many per month now. Or you see a big spike in the usage of a swap line or a standing repo facility, something like that just provides temporary liquidity until the Fed steps online. And so that's why these things are global markets. When you have China, Japan, the US, parts of Europe, but they're increasingly kind of a smaller part of it. When you have these really big entities run into crises, you tend to get these ripple effects in other markets because they have a lot of levers to pull.
Luke, do you have anything you want to add or disagree with there?
No, I think that's right, and I think it flags too the sort of this part of the kind of the great game, which is on one level, Japan being close to America is very useful. We can supply them energy, we can give them swap lines, etc. The flip side of that is Japan can't buy energy in anything other than dollars if they want to stay our friend. And the Chinese don't have access as much to the swap lines, etc., but they do have a greater ability, to buy energy outside the dollar in yuan, and have been doing so. And you say, okay, well, two of the three biggest oil suppliers have been doing that. One has been taken over by the U.S. The other is currently under attack by the U.S. And you'd make the case that the third, Russia, has been under proxy attack by the U.S. For the past 4 years. So maybe past 10 years, arguably, really 10, 12 years, if you go all the way back to the Maidan, etc. crisis in Ukraine. So that then gets back to sort of the geopolitics around, okay, well, it is those are the levers, and they're sort of first principle tensions that we're watching play out even as we speak.
CoinKite has been in the game for years, creating hands down the best and most secure hardware when it comes to securing your Bitcoin. The Cold Card Q is an absolute powerhouse and my daily driver, and it's ideal for newcomers and advanced users alike. The Tap Signer gives you a low-cost, user-friendly option for those just getting started or for convenience when traveling. You can head to coinkite.com and use code BTC Sessions for discounts, or simply scan the QR code on the screen to get started right away. One company I like pointing people to when they ask about Bitcoin mining is Abundant Mines. They were founded by Bo and Christine Turner after losing over $500,000 to broken promises in the mining industry. and they built their hosting model to remove the usual headaches. With Abundant Minds, you own your machines and keep 100% of the Bitcoin you mine. There's no revenue share, no hidden skims. Pricing is simple. One flat monthly fee covers power, parts, labor, and repairs. They also guarantee uptime. If a machine goes down, their hash rate redirect system routes hash power from their fleet so earnings don't just stop, and every machine is insured at full replacement value. Everything is hosted in the US, powered by Hydro, and mining equipment may qualify for 100% year one bonus depreciation. Learn more at abundantminds.com/sessions.
Very interesting. I want to jump back for a second, maybe push back on the theory just a little bit, Luke, and you can tell me where I'm going horribly, horribly wrong. So we had the idea, we even mentioned at the beginning of the hop, the idea of it being like squared off and done this week is not likely in your estimations. You think this is going on for longer. And then additionally, we're talking about like oil hitting like $200 a barrel. I'm looking at crude futures right now, and I'm seeing for June contract, $98, July, $89. If I go all the way out to December, we're looking at $72.93 a barrel. So my question is, are the futures contracts indicating that they think there's going to be an end to this relatively soon? Or is this potentially reflecting something else, maybe even something worse like demand destruction causing oil to fall? Or is it just noise? We don't put any value necessarily in those kind of contracts.
I think it's a little bit of each of them. I think, you need to look at relative trends, right? So I had a friend of mine who's been in the energy business forever pinged me a couple weeks ago, said, the December contract hit 70 for the first time ever, a couple of weeks ago, right? So that number has been rising, which tells you the markets have been saying, "Ooh, okay, this might last longer." Then you have to look at the relative liquidity of those contracts. I would think in oil, they are probably pretty liquid, but I think it is partly that there's still not a belief that this thing can go longer. I think there's some real informational value there. And then I think it's the demand destruction too, right? I mean, it is a balancing everything I'm kind of saying about, look, if the world's going to start coming unhinged by, 2 to 3 weeks from now, as a result of this, if Hormuz is still closed, then yeah, you're going to start to have some reflexivity of trying to do a calculus around, if I can't get oil and it's really expensive today, and then there's a factor into that. So I think it's a little bit of all of those factors probably playing into that.
Lynn?
Yeah, I don't disagree with any of that. Nothing particularly bad either.
All right, beautiful. I'm curious then, Lynn, in terms of other indicators in the market, what actually has your attention most right now? What are you kind of focusing on the daily that you're using to try to find some signal in all this noise?
Well, so we are unfortunately a very headline-driven market. So there are periods of time where like things tend to lead into the next thing, like monitoring a liquidity situation. In the past, now we're in a very headline-driven market, so things can just become nonlinear very quickly. So one is, unfortunately, I have to monitor the news first and foremost. And then aside from that, I am monitoring. I mean, just what's happening in the Strait. Is any energy, are certain deals being made to get at least some energy out? Is it going in the right direction, or is it not going in the right direction? I look for things like what are countries doing about mitigants, and then because my focus is on markets and finance, as a profession, I'm focusing significantly on liquidity. I'm looking at things like are cracks forming or not yet in liquidity situations. I watch things like Japanese Treasury yields. I look at things like are any Fed kind of liquidity facilities being used, and if so, how much? What are kind of funding spreads for short term institutional lending, securitized lending? I look at those kind of move index. Of course, are there kind of days we have stocks down, bond yields up, and dollar flat to down, and that's kind of emerging market behavior. Do you see days like that in Japan? So kind of like just how signs of like how quickly this is playing out versus slower scenarios. There are key analysts that I follow that are specialists in the oil market. So I kind of watch their temperature on any given day. What are they freaking out about or not freaking out about? Have they kind of revised any of their guidance? But yeah, a lot of it today, of course, is about the Strait, about downstream effects from the Strait, as well as liquidity specifically, because that's where ultimately this starts ricocheting back into other things.
Luke, I want to maybe go down a dangerous path here, but we'll see how it goes. everything is centered around the Strait. That's where all the attention is. That seems to be the main driving factor in markets right now. I'm curious from your perspective, why are we there? And who benefits, if anyone? So, for example, like I can make a case that maybe Russia benefits from like higher oil prices, but I'm not actually sure. It just seems like everyone's kind of waiting and taking it on the chin a little bit. Is there anybody in the financial landscape or macro landscape that benefits from this? And I'm curious your thoughts as to why we're there to begin with.
It is a dangerous question. There's a school of thought. There's multiple schools of thought on this. Um, there is the school of thought of what I would call Iran jihadis, right? They're the jihadis against Iran, right? And so, hey, Iran's going to get a nuke, and anything else, like, hey, we might crash the economy. It's worth it. Hey, we might, it's worth it. Hey, we might starve 1 billion people in emerging markets. Hey, it's worth it. That's one school of thought. There's another school of thought that that this is sort of 5D chess, and that ultimately either 5D, and it's, you kind of get the same way. It's either 5D chess that we can really squeeze China's oil supplies and thereby increase our leverage vis-a-vis rare earths, which they've been holding over us since well, certainly since Liberation Day. And there's maybe something to that, or trying to strategically break China's ability to buy oil outside the dollar, maybe something to that. There's sort of a different version of the same thing, which is sort of bombing in that we're bombing inside the wire. There's a lot to suggest that maybe we're losing to AI, losing an AI to China, or very close to it, and certainly losing in other areas. And maybe somebody made a decision that, hey, it's sort of like, we were soldiers once and young. Once they were inside the wire, you call broken arrow, you call the airstrike inside your own wire, and you kill some of your own people, but you kill everybody, and you hope some of your guys live. And there's an element that I think says that that's the case. And that's essentially just saying, hey, we're going to lose this round, right? So when you were a kid, we're going to lose this Monopoly game, and I'm angry. So before I come back around and have to pay you another $2,000 in rent on your hotels on Boardwalk, I'm going to flip the board, punch you in the face, and go outside and play kickball or something. And in that world, like, look, we do that. The rest of the world is going to starve first. That's how it's going to work. And quite frankly, American cities are going to starve right alongside the world. Like, you're not going to want to be an American. People are like, well, we're better off. And this is, like this net part I was talking about earlier. Like, yeah, on a gross base, America will be fine. You're not going to want to be in New York City if this goes as bad. If we're starving Asia, if we're starving, 1 billion people across the global South, you're not going to want to be in cities in America. Not at all. And then there's two other thoughts. There is a school of thought that, I have to phrase this delicately. This one is as I have from a very credible source. There is a school of thought that it is in the United States' strategic interests to let Iran and Israel beat each other to death in a controlled fight. And if Israel and Iran beat each other to death, that actually helps United States strategic interests in a number of areas, because both of them become threats to dollar reserve status in different ways. I don't know how I feel about that, but again, I have it on very good account from a very credible source that might be the case. So that's another school of thought I've seen that actually makes some sense, because up for the last 10, 12 years, Trump has been, love him or hate him, he's had very good political instincts. And this on the surface seems just stupid. So that would actually make some sense. And then the final that is, for me, still the Occam's razor explanation, and therefore my base case is, he kicked a beehive, and they thought it would be easy after Venezuela. And now the beehive is stuck on his foot and he doesn't know what to do. And so he's getting angrier and angrier because he didn't listen to his intelligence. And there wasn't a plan for what would happen after, on the decapitation strike. And that is still my base case. But I'm open to sort of all these other things, and conveniently, the longer Hormuz stays closed, the less any of these really matter as terms of the why. All that starts to matter is the what. But they all at some point converge on, holy cow, the system is collapsing if we take Hormuz closed long enough. But those are sort of, the different whys we're there that I have circulating around in my head, that as I watch headlines and stories and markets all sort of play this out.
Lyn, I'm curious your thoughts, if you have any insight or theories as to why we're in this conflict to begin with, and even if not, if there's any economic or financial benefactors that you see. Is somebody profiting from this outbreak, from this conflict?
Well, potential insider traders are benefiting.
Yeah, that's a good one.
I mean, basically, I side with the Occam's razor as by far my highest probability case, which is that they thought this would be easy. They kicked a beehive, and now they're scrambling. I think that there are always that segment of neocons that pretty much always want to deal with the Iran issue. They found the guy that would do it. I think they were on a high after the efficiency of Venezuela operation. I think Trump thought he could basically decapitate any kind of secondary or tertiary country at whim. And I mean, Venezuela is a corrupt socialist state. If you take out the top guy, you can just negotiate with the second person who just wants to buy luxury stuff and keep their job. Whereas in Iran, you're dealing with a lot more hardcore ideologues that you can kill layers deep, and they're still going to troll you on Twitter and refuse to open the strait. And I don't and they've got very good engineers, as we've seen from these drone attacks, and they've also planned for us trying to target their operations and disable their capabilities. And they built clearly a lot of resiliencies in this, despite other criticisms I would quickly lay at Iran. I'm certainly no fan of their regime, but in this area, I think the administration underestimated them. And you can have, it's like you can go downstream as you want. I mean, like, so this administration's not really been strategic, to say the least. I mean, I was on the record ahead before Doge. I was like, Doge is not going to work. It's not structurally. They're focusing on the wrong point here. Doge is not going to work. It was a blip in the radar. And then the tariff operation, like it's you do emergency powers to put in tariffs. You claim the rest of the world's paying for 100% of them. It's just on the surface not accurate. I do think that they were correct to focus on the trade deficit for a change, which administrations have not been doing. But then the actual mechanism to do that is messy. If you look at Stephen Myron's paper, which was kind of like the Steelman version of what the administration wanted to do. They published a paper back in November 2024 when he was becoming kind of Trump's like chief economic advisor. They kind of said, if you were to restructure trade, here's how you would do it, and it outlines mechanisms and risks. I generally disagreed with the paper at the time, but there was parts of it that were logical, and you could I had a more pessimistic snare on the outcomes, but I think a large part was that they underestimated things like the net international investment position, the difficulty of reshoring supply chains, the network effects of manufacturing hubs. So they thought that by hitting hard with these tariffs, the dollar would go up, and that they would then be in a very strong negotiating position to get all these new deals. It didn't work out like that. And then because the tariffs were put in using emergency powers for non-emergency purposes, a conservative-leaning court struck down a conservative president's tariffs. It's also just complicated because, in general, fiscal conservatives are not in favor of tax increases, and that was effectively a tax increase that was at least partially on Americans. So that was like an unsound, it's like a short-term focused strategy that's just kind of built on paper, rather than, say, if you wanted to implement tariffs through Congress that are more persistent, you could, but you didn't build the coalition to do that. Partially because and then then it's like then the whole Epstein fiasco, right? And then just Epstein gradually declining poll numbers. Wars historically are kind of effective for distracting. I think Trump, obviously he takes things personally, so I mean, he didn't like Venezuela and their response, and then that operation happened, and the special forces clearly did a very efficient job with that. It was kind of shocking how just clean that ended up being. I think then he was probably riding a high from that and said, well, why not cement my legacy by, ending this 50-year kind of issue with Iran? And it's not the same. And so, maybe there are scenarios where they could have nailed it, but it's structurally different. Geographically different. It's ideologically different. And I think we were replaying why we can't just kind of play God with the rest of the world and assume that we can just keep doing things, and just after a time that they never light on fire, they never come back to hit us. So I think we're scrambling. And of course, there are parts of, there are advisors that are trying to play 4D chess. There are, in any sort of king's court, there's multiple competing factions, and you'll have dumb ones and smart ones and, all manner around. But I think the actual outcome, the decision-making process here, I think it's the Occam's razor. I think it is the mess that it seems to be. Yeah, I mean, the White House still has up on their website, last I checked, from June of last year, Iran's nuclear capability has been destroyed. Anything else that claims otherwise is fake news. That's sitting on the White House website while we had to go in here ostensibly for nukes. I think it is actually as cartoonish as it looks. Like, I think we live in a simulation, and we're in like the crazy version.
Well, and the scariest thing to me is how many times I hear from, serious investors, people on X. Well, it's all fine as long as, Besson's the adult in the room, right? Like, he's the adult in the room. How many times you heard Besson's the adult in the room? I was in Denver at a dinner in January 25, and with a friend of mine who's an energy, former energy exec, and he goes, I'm hearing that Secretary Chris Wright's trying to sell his oil company, his shale company, and he can't find any bids. With oil, it's $73 at that point in time. No bids because they can't make the math work. All right, so here's our Secretary of Energy, Chris Wright. Literally that weekend, I was at a conference where I met with somebody else. It was Chatham House Rules. So I can tell you what they said, not who it was. But they told me they had just met with Besson. Besson had brought them into wherever, New York or Washington, to explain sort of the sort of supply-demand situation of the United States oil production base. And this person goes, look, if you look at sort of, where we are at the four main, where the growth of production has come from in shale and in liquids, and if you look at where those are, and if you look at the break-even prices, Mr. Secretary or Mr. Secretary-elect, whatever he was at the time, I know you're saying one of your three arrows is increasing production by whatever it was, 3 million barrels a day by 2028. But Besant was also saying we're going to get oil down to 50. And this this analyst goes, Mr. Secretary, you're not going to be able to do it at 50.
The math doesn't math. Yeah.
Well, and here's the incredible thing. The adult in the room told this person, I don't believe you. Thanks for coming. Now, apply that to this whole nonsense. And so if the adult in the room, if that's the thought process of the adult in the room, basically, I'm God, it doesn't matter. Well, now he's 0 for 3 arrows, by the way. Let's start there. But then the other thing they didn't factor in all this is other great powers get a say. Like he was just saying, Russia and China, Iran is existential for both of them, too. And I'm told on very good account that 2024, when we were helping the Ukrainians shoot missiles, not helping, we were shooting missiles into you. We were basically just taking the Ukrainians' hand and putting it on the button, right, of shooting missiles into Russia and high-fiving each other, chest thumping, we're awesome. And the Russians wouldn't take the bait. But they did say, we reserve the right to respond at a time and place of our choosing. Well, it turns out the time and place of their choosing was about 2 days into us attacking Iran, because all of a sudden, all of these people who are planning this thing are like, oh my God, how are the Iranians so accurate? Well, it turns out they were using Russian and Chinese satellites. And so this isn't a war against Iran. This is a war against Iran backed by the Russian industrial base and the Chinese industrial base. Because everyone's like, oh, we're going to choke out China. What do you think China's going to do? They've already said in Chinese language, they're going to support Iran. The Russians are absolutely supporting the Iranians. And so when you have two countries, Secretary General of the UN, Mark Rutte, said in January 2025, the Russians have outproduced all of NATO 4-1 in Ukraine. 4-1. So the Russian military industrial base is at least four times the size of ours, because that's all in NATO. So it's probably more like 5 times the size of ours. And the Chinese military industrial base is probably 10 times, 20 times, 30 times the size of ours. We picked a fight with and oh, by the way, the Chinese make a quorum of our military for us too, several layers down. So there is just a level of, I'm going to try to be delicate, a lack of second and third derivative thinking, a lack of understanding the first principles in which you are operating amongst the adults in the room, let alone sort of, the president, who this weekend showed he's maybe having a little bit of stress, maybe having a little bit of emotional breakdown. I don't know, but yeah. So I don't know really why we're there. I mean, I just think it's gone really pear-shaped really now. Look, are we beating them up badly tactically? Absolutely. Are we flattening them? Yes. Can we kill them all? Yes. What does that make us? Like, not to get all philosophical on a finance, but like, what does that get us? And at what point does that draw in? Again, this is existential for China and for Russia. This whole, can we do it? Just because you can doesn't mean you should. And certainly you shouldn't if you've already demonstrated you have no ability to think about second and third derivatives, which this administration, from the smartest to the dumbest, have all shown they have no ability to do that.
It seems
Yeah,
to me like at Cleveland.
I think in some ways we actually kind of repeated Russia's mistake. So Russia, of course, invaded Ukraine. They thought it'd be a quicker, more decisive operation. It's now going on for 4 years. It's one of the situations where, I mean, Russia's not better off, Ukraine's not better off. The number of dead is just off the charts. The number of dead Russian men, Ukrainian men, women, even. Just the sheer amount of resources that have gone into that could have been going into other things. Like, it's like you look around and say, who's better off, right? It's like a lot of these things, it seems that that will claim to be strategic is often just the hubris of a handful of people, either for legacy or for their own enrichment. And then the U.S. has been kind of trying to, with some success, some failures, trying to make Russia pay as much as possible by, of course, funding and to Luke's point, we're providing resources in various ways to make it harder for Russia. And the U.S. then turned around and 4 years later we fall into a similar trap, which is we go in expecting a quick operation, and then Iran's backers are like, well, let's make this as hard as possible for the Americans if we can, rather than just roll over. And so we're kind of in ironically a similar situation. I mean, we're only a month in rather than 4 years, but this one has so far a bigger impact for the world because 20% of the world's energy is 2 miles from their coast.
Did the U.S. potentially idiocracy its way into the gradually then suddenly moment? Like, if this actually pros on long enough, because Luke, I know you've mentioned before that basically, so if I understand correctly, the GCC countries are selling oil for dollars, then cycling those dollars back into U.S. treasuries, which is then funneling into the military industrial complex and all the spending that the U.S. Does. But I also would imagine, and I suspect that the GCC countries also funneling into equities as well, that they might want to go out on the risk curve and might be buying U.S. stocks as well too. We always talk about the at least in Bitcoin, the end of the dollar at some point. If this went on for like a really long time, could that actually be, we say, like a definitive moment where you can say like that was the end of the US dollar hegemony? Like that would be the point where everybody else would start using barter systems, other currency exchanges? Or is it still so entrenched that even if this went on for 4 years, like Ukraine, that wouldn't happen?
I think you have to define what is end of hegemony or end of dollar hegemony. I think dollar usage will still be 80, 85%, whatever, 90% payment. Cause any Chuck E. Cheese token will do when you're looking to get to the prize window, right? It doesn't matter. look, when I wrote the first, the bomb started flying February 28th, March 3rd, I wrote that Iran doesn't have to beat the US military, they just have to beat the US Treasury market. And in that report, I said, look, this has the potential, if it goes the way I think it's going to go, to become a US Suez moment where, for like the UK, it was sort of when it became apparent to everybody that sort of the hegemonic period over the UK was over. And look, I think that's now the best case. I think a Suez moment for the US is now best case. Um, because we can look and see what are the outs here. The outs here, the most likely outs are we declare victory and go home. In which case, A, the Iranians will have dealt a strategic defeat to the United States of America. Everyone in the world will understand that, except for the sort of, Iran jihadis and certain elements of MAGA. Option 2 is we keep going. And look, one of the dogs that is not barking this week, everyone's like, oh, great rescue. And it was a great rescue. And they're very brave. Why did it have to happen? Our president told us on Wednesday night that their military was destroyed, their army destroyed, navy destroyed, decimated, crushed like never before, blah, blah, blah. And yet, next day they shot down an F-15. And then the next day during the rescue, they shot down 2 C-130s and 4 helicopters. Like, so that just gives us a little taste of what putting ground troops on the ground is going to do. I've been a new Gallipoli. Luke watched the opening scene of Saving Private Ryan, knife fight in a phone booth, whatever metaphor you want to use. That's going to happen. And that is going to be, look, we got into Vietnam. Yeah, that was the end of the dollar. That was the end of Bretton Woods. So it strains credulity to think there won't be, that won't be that outcome. And then I guess the last option is, really one of two options. Number one, like the Iranians get a say, right? Even if we say declare victory and walk away, they keep shooting. And if I'm them, I'm going to keep shooting. Absolutely, I'm going to. That's an indictment. And the last one is, look, we do something extreme, like we go in and we nuke them. And like every day this goes on, that it is not going tactically, it's going fine for us, but strategically, when you run out of interceptor missiles, what do we think Israel is going to do when they completely run out of interceptors? Which, oh, by the way, they probably need Chinese rare earths to maintain supplies of. What do we think they're going to do? I don't know. Would they do the Samson option? Maybe. Then what? So there's these, and I guess the last thing is the Iranians are they're telling you they'll let oil move for yuan. And people say, well, there's no, yuan is it's a closed capital account, blah, blah, blah. They're missing what the Iranians are doing. That's gold for oil. How do you get yuan? It's simple. You sell dollars, you buy gold, you take the gold to China, you sell the gold to China for yuan, you take the yuan to Iran, you buy the oil, you put it on a boat, you sail it out of there, and away you go. And so that option is absolutely the end of the post $71 system. That is a, whether we're allowing it to happen, or as some assert, or whether we can't do anything about it, like sink the Chinese boats moving the stuff, doesn't matter. You've got a yuan oil system parallel running alongside the dollar oil system, and that is de facto the end of the dollar's post 71 status. So my best case, the happy outcome at this point is we walk away. We let them keep control of the Strait of Hormuz. They continue to transact in yuan through gold. Gold goes to the moon. The dollar falls sharply. That facilitates a reindustrialization of the U.S., high inflation, probably yield curve control, capital controls in the United States. That's the good outcome at this point. They all get uglier from that point.
Yeah, I mean, I think there are multiple. I think Luke described it well. I think there are multiple layers. Over time, technology changes, and so what was once dominant, like the carrier group, when you have things like hypersonic missiles or very effective one-way drones that cost $40,000, it's just the math changes to some extent. So it's just that you could have competent people running things, and that still could just chip away at things. Then, of course, we're 50 years into the Triffin dilemma. So the U.S. has deindustrialized itself to maintain its global reserve status. It's kind of it's a natural just flywheel that gets into effect. It's not even always a decision. It's just the network effect of the dollar system. And so we just our ability to replenish things is lower. Our manufacturing hub is weak compared to China's and elsewhere. So those are just kind of like all like just serious realities that were happening, which then increase the odds we run into a strategic defeat like here, which then has downstream implications for the currency for other things. I've argued before that, like most empires, when they could just see that, okay, we've overexpanded, we're doing great, but there's a lot of risks ahead. We can just like right size our borders to make sure we're defending the right spots, and like we're going to focus on inward flourishing. They rarely do that. They try to maintain every border they have. They lose all their blood and treasure to try to maintain what they have because that's what the emperor wants to do. And so far, we're on that path instead of kind of retreating from a position of strength gracefully, leaving other people's problems for other people. We've decided to do more boondoggles. But I do think that the dollar system, short of extreme scenarios, has a very long life to it, because and a lot of this goes down to just the math of it, which is there's like tens of trillions of dollar-denominated debt in the world. All of that represents inflexible demand for dollars. It's mostly not even owed to the U.S. It's owed to other cross-border entities. That can be chipped away at over time. You can do defaults on it, but then you get very nonlinear financial outcomes, both in the U.S. and globally. There's a very complex game theory with that. You don't want to be the first one to default, or even the first 5 to default, usually, unless you're the biggest to default first, or like restructure is the polite term. And so I do think that I would separate the risk of a military kind of strategic defeat from the dollar system itself, at least in any sort of like near-term timelines, even though one, of course, can lead to the other over time. And I do think that regardless of this particular scenario playing out, I think we were already headed toward a more multipolar world in terms of what sovereigns store their reserves in, and then to some extent, even what they denominate payment in, so that they can't be like sanctioned or censored unilaterally. So I think we're already seeing just a natural shift there. And then I'd argue it's even in the U.S.'s interest to let that happen. That would have been an example of letting things happen kind of gracefully and kind of focusing on inward stuff rather than trying to maintain that unnecessarily. But this, I think, is an accelerant. There are moments in time where, like the UK losing its reserve status was a process that, there's World War One, then there's World War Two, then there's the Suez moment, and then there's the rise first of kind of the in the early stages of that, the German economic power, then the rise of the American economic power. So there was this like gradual handover. And I think this is one particular moment. I think the Iraq War is already an early moment. That was kind of let's call it World War One for like, losing status. It's like that's the first shot. And then, you have a global financial crisis, then you have COVID, then you have like lockdowns and things like that. And then you have, and the stimulus, and then you have, this rising conflict between the US and China. And then you have this particular moment. I think these are all kind of like flags along the way toward a more multipolar world. And all of that can be true without the idiocracy component. But then you mentioned idiocracy. I mean, I do think that it's an oddly prescient movie because that was like a pro wrestler president. We have a reality star president. We were in a situation where we're like facing an election between a senile guy and a reality star. And like when the senile guy had to drop out, we had a person who couldn't win her own primary if she had to. So we skipped that. It's just the way the timing worked out. And so we find ourselves in like the silliest timeline. And then we had, like Doge, Epstein, Iran boondoggle. It's just, we're in kind of, we are. That idiocracy component is kind of happening alongside of what otherwise could have been these similar things, just slightly smarter.
I think it's too. It frames why, Lynn, the point you made about the entrenched dollar debt is I think why what Iran's doing with the yuan and I think gold is so important is that's the one way out of it. You can get that's the escape hatch to it is, look, if you start using oil to bid up gold, physical gold, the oil market's still nine times the size of the gold market, even at, $5,000 an ounce. So at $45,000 an ounce, um, sort of the implied valuation of the dollar and the real burden of that dollar debt start to look very, very different. You can
Yeah.
you're gonna that $40,000 gold, $20,000 gold, you're gonna have a lot more collateral around the world with which you can sort of redenominate that dollar, those euro dollar claims,
Yeah.
without that crisis. And I think that is in no small part of the reason why gold has been managed by the United States and the Anglo Americans more broadly, the city of London more broadly, is to prevent gold from getting big enough to drive that network effect that then allows the world out of the dollar system painlessly. Um, and I think on some level, that's part of what we're watching is because it's through oil that happens. It's through commodities that happens, and let's see. And I think that's when you kind of then tie that back to, is this going to be a strategic loss? Um, that's, I think, a very important dynamic to it, because that is, I think, the sort of the one way out of all of that dollar debt is you just devalue the heck out of it with gold. You replace the dollar collateral with a greater increase in the value of your gold collateral, and away you go. And that's not necessarily a worse world for the US. It's certainly a much better situation for sort of the part of the US that wants to reindustrialize. There's still sort of this fantasy going on, I see on X, that we can maintain the dollar system as it's been structured for the last 50 years, and we're going to make all of our own weapons and industrial base and reshore. And it's like, no, you're not. Pick one.
Agreed.
Very good. Before I ask a final question here, I did just want to pose to you guys. Lyn, do you have anything that you want to ask Luke? Or Luke, is there anything that you want to ask Lyn?
The problem is we agree on a lot of things. So it's
That
always,
was it. I was
it's
looking for
tricky.
little
Yeah.
nuances of where you might disagree. I'm like, nope, they're both telling me that if we don't get this open, we're screwed. Okay, duly noted.
Yeah, I mean, look, I'm a guy. If I disagree with you, I'll tell you. But I'm sorry, what were you going to say, Lyn?
I was going to say, I guess a question I would try to drum up is, if you were to map out what is your current map for kind of the order of breakage? Let's say the Strait of Hormuz stays completely closed for 6 months. What is like your rough order of kind of like who cries uncle first in terms of like major powers, in terms of running
Yeah,
into
I
kind of
think it's going to
crises?
be. Yeah, I think it's going to be like it's a neck and neck between Australia, UK, and like Southeast Asia. So like Vietnam, Thailand, type Korea, region. And I don't know which of those. And then some European countries probably, if they can put down their egos enough to buy energy from Putin, they might be fine. Of course, Ukrainians are now making that worse by blowing up lots more energy, it seems like, in Russia. No. But I think that's where you'll see it first. And I think you'll see it. I think the COVID shutdowns are somewhat instructive, right? Is I remember one of the wisest people I know pointed out, I think tourism, it's like 8 or 10% of global GDP or something. It's like a staggeringly high percentage. Oh, yeah. So like people are like, well, don't worry, it's just them shutting down flights. And you're like, no. You don't understand. We've already lost 10% of the world's oil. You shut down tourism, it's over. It's over. So, and then that might turn, that is where I could see kind of that acceleration. I'm just waiting for, I don't know what I saw it phrased as the Tom Hanks moment for COVID. And I wish I could give whoever coined that phrase credit. I'm sorry if you're watching this, but they called it the Tom Hanks moment, where this reminds me so much of COVID. Like, we can all see it's closed. We can all do the math. We all know that it's not good. We're all sort of like, well, maybe it'll go away. And admittedly, I was one of those people. I'm like, it's just a flu, right? And and then all of a sudden, Tom Hanks got it, right? You remember that Tom Hanks, like, I have COVID and we're and everyone's like, ah, and like that was the freak out moment. Like, then we had shutdowns and blah, 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 blah. And I don't know what the Tom Hanks moment will be, but it's coming, and it'll be, oh, like they're like sort of, and so, but I do think amongst the major powers, that's how I would lay it out. How are you thinking about it?
Similarly, I think probably that I tend to be kind of probably a little more bullish on Asia in the sense that I think they'll be pretty effective at pushing a lot of the problem toward the developing world, which is that I think the Taiwans, the Koreas, the Japans will likely be able to bid enough. I mean, they are. I mean, Korea's already rationing. I mean, like
Yeah.
these things will show up there. But I think that they will avoid kind of the worst scenarios most likely by pushing those on to the Egypts, the Pakistans, the Bangladeshes of the world. Um, you know, the, and I tend to be not very constructive on Europe. So I tend to think that Asia, at the end of this, Asia is kind of in a stronger position than Europe. But I think that, like most of these crises, I think the developing world pays the biggest price. They're the ones with they get the acute shortages where everyone else gets severe inconveniences. And in the US, we have this weird situation where you have like two Americas, right? There's like one America that's like mostly goes, they're kind of the one of the last to get hit. And then there's the other part of America that's kind of right alongside the folks in Asia and Europe that are getting hit pretty quickly. As soon as gasoline's like $4 or $5 or $8 if you're in California, or what, it depends on across the country. And like they can barely keep food on the table without, cutting health insurance or something. They're kind of right alongside, say, the South Koreans in terms of how impacted they are. Um, so, but it's, there's always little guideposts that can happen that can then rearrange how things look. So
In Canada, I think the federal government was already floating the idea, or someone was pushing for the idea of having federal employees work from home. So I'm fully expecting like energy lockdowns in UK, Australia, Canada at some point in time. I completely agree that this smells a lot like the COVID setup to me. It seems very, very familiar, and I'm kind of watching for that. The last thing that I want to make sure we touch on, got to make sure we touch on it. Luke, I will reluctantly admit that your timing was quite good, despite the fact that I don't want it to be. Bitcoin has been for about since February kind of trading sideways within range bound. I'm curious your thoughts on Bitcoin at the moment and how you see things progressing.
I am, I actually posted some about this morning about that. I've been fascinated to see how it didn't get hit in March, and sort of the trying to ascribe a motive to it. Is like, wow, is this capital flight out of the Middle East bidding it, whatever? And then I ran the chart of Bitcoin against IGV software, and it's still the same chart. And so it looks like it was just, okay, Bitcoin got killed with software in February, and they've both been kind of hanging out, maybe because software is like, all right, not going to get killed as badly by oil for the moment, or it's a secondary concern, the concerns that were in February, to what's going on elsewhere. What do I think? I've still not added back anything I've sold. I am very interested, watching very closely. My view is that this war is going to go a lot longer than people think, and the disruptions are going to go a lot longer than people think. And I think ultimately that's bad for risk assets. And if it's bad for risk assets, it's going to be bad for Bitcoin. So I still think I'm going to be able to buy Bitcoin in the 40s, maybe lower if things really, but that is a very loosely held view, depending on, like, look, we get, tomorrow war off. I fully expect Bitcoin to be at 75, 80. And if there's real, I might not be able to buy it back till, 90, and then it won't look as smart a trade. So it's not something I have like super high conviction in how it could go, because it is basically beholden to Trump and the people that got us into this, a decision in a room, right? That's, to me, if you think they're going to sort of walk away from this and this thing's going to end in the next couple of weeks, Bitcoin's probably a better buy here. But I think there's very little chance of that happening. So I'm still cautious in the short run. But
Lyn,
I
Bitcoin?
think that's a reasonable view. I think Bitcoin and the software sector, they continue to be uncannily correlated. I think part of it is that the software sector got so cheap that basically, like, some of them the value investors are kind of watching that space now. There's like less of an outright sell bid, but it's still not catching an upward bid, but the bleeding has slowed. So I think that'll probably continue to correlate with Bitcoin. I think they'll both kind of find bottoms. Historically, Bitcoin tends to find bottoms gradually because it's not like a stock where it can just have an earnings announcement that surprises you the upside and then it's off to the races. It generally you have to churn out the fast money. All the coins over time slide into the diamond hands, and Sailor owns a lot of them, and then people that just never want to sell, and then over time they're just basically sellers get exhausted, and then we either get a better liquidity environment or something. We start to get a small amount of interest until you kind of eventually relight that fire. The exception, of course, was COVID. You had a downward spike from liquidity where gold, silver, Bitcoin, just stocks just straight down, and then you had the giga stimulus, so straight up. So if we do get outright liquidity problems, where like the dollar just the Dixie spikes by 10, and the move index just breaks, and off the run treasury markets break, and there's a couple days for the central banks to get their act together before they help with the giga print. We probably see days where Bitcoin could fall 5K, 10K in a day, and it looks like COVID. I'd be a buyer of those kind of crises. But they're hard to predict. They're more just like, if this happens, this is likely why it's happening kind of scenario. I think outside of that, I think we probably grind for a little while, and then when you do start to get, say, bigger stimulus or resolution to this one way or another, I think that Bitcoin's already gotten a lot of the fast money out. It's already shifted a lot of the coins toward the stronger hands. Some of the folks in the 50K range, like the 58K gang, they're still, they still got a shot. So maybe lower, like if you get a liquid kind of spike down. But I think it's an interesting time to layer in. I'm watching other risk assets. There's like, say, Latin American banks or like some of these airports that are like obviously not ones you're jumping in yet, but you kind of watch them, and I think there's like this set of risk assets, or these things that are priced like risk assets. At least Bitcoin's self-custodial, but it's still priced like a risk asset by most pools of capital. So you have Bitcoin and a couple of these kind of beaten down areas that I think it's still, from a trading perspective, too early to say, okay, you want to ape in now, but it's like you have them on your watch list. If they do get really bad days, you might start layering into them, but that you really want to probably see a light at the end of the tunnel before you'd make the trading call that they're going up.
Beautiful. Awesome. Lyn, Luke, this was absolutely phenomenal. Thank you so much for taking the time to sit down today. Before we go, Lyn, please tell everybody where they can find your beautiful new book and your newsletter and all that stuff, and then Luke, you after.
Sure. People can check out lynalden.com. And I have a new sci-fi novel out, and part of the reason I wrote it is because we already live in a simulation, clearly. It's like my way of it's like, let me just write about sci-fi stuff because that's in some ways more normal than what's going on now. So yep. I was like, it's like fiction's less extreme than reality. So people can check that out if they want something fun to distract themselves.
The Stuttgart incident, correct?
The Stuttgart incident. They can find it on Amazon, Barnes and Noble, elsewhere.
Beautiful. Luke?
FFTT-LLC.com and at Luke Gromen on X is where people can find me.
If you enjoyed this episode with Luke Gromen and Lyn Alden, please do like and subscribe. It really helps us out. And check out the previous episode with Professor St. Ange.